Alright, let's start with lump sum investing, often abbreviated as LSI. Imagine this. You've just received a lot of cash, perhaps an unexpected inheritance, a generous bonus, or maybe you finally sold that vintage collectible for a hefty profit. Now, with lump sum investing, you seize the day and plunge headfirst into the market. You take that entire chunk of cash and invest it all at once, no hesitation, no second thoughts. It's like stepping off a diving board straight into the pool. But why would anyone choose this seemingly all-or-nothing approach? Well, the allure of LSI lies in its potential for substantial returns. If the market happens to be on an upward trajectory, you're essentially buying at relatively the lowest price you'll be able to get. Every dollar you invest gets immediate exposure to potential growth, and the longer your money stays invested, the more time it has to compound and potentially multiply. The simplicity of LSI is another attractive aspect. It eliminates the guesswork of trying to time the market, which is a notoriously difficult task. With lump sum investing, you are not attempting to predict when the market will peak or dip. You simply invest and let the market's long-term trends work in your favor. This approach can be especially appealing for those who prefer a hands-off approach to investing or who don't have the time or expertise to monitor the market's fluctuations. However, as with any investment strategy, LSI isn't without its drawbacks. One significant risk is buying at a market high. Imagine pouring all your money into the market just before a downturn. Suddenly, the value of your investment plummets, and those dreams of rapid growth might feel like a distant memory, and you might spend years just getting back to zero. But worse than the mathematical drag on your portfolio, witnessing your investments decline in value can be a nerve-wracking experience. Even seasoned investors can feel the sting of anxiety when their portfolio takes a hit, especially if it's a sizable sum of money. This emotional toll can lead to impulsive decisions, such as selling at a loss to avoid further pain. So while lump sum investing offers the potential for higher returns and a straightforward approach, it's important to be aware of the risks and the potential emotional impact. It's a strategy best suited, in my opinion, for those with a high risk tolerance and the ability to weather market storms without making rash decisions. This is just a part of my video about dollar cost averaging versus lump sum investing. To check the full version, click on the video that should have appeared on your screen right now.